In this session, we're going to talk about registered retirement income funds. When you buy an RRSP, you can make deposits up to age 71. But at age 71, the year you turn age 71, you must begin to take money out, so to speak. In other words, you have to annuitize that money, okay? And so you can start a registered retirement income fund anytime you want. You could be 60, you could be 55, it doesn't really matter. Saying is you cannot keep it any longer than age 71. And this again complies with all rules in terms of registered money. In my previous sessions, I've told you many, many times, that age 71 for registered money is the absolute deadline, and that's it, okay? So the maturity option for an RSP is, in fact, a retirement income fund. You could also buy a life annuity if you want. That's, again, up to you. But for our session today, we'll just talk about registered retirement income fund, okay? So the fact that you now have rolled this money over to a RIF. Now let's say you are 71. So you rolled over the money over to a RIF so that it begin to get a monthly payout, so an annuity payout, okay? That means that there's a continuous tax deferral. So all the options that you had, all the places where you were investing your money in your RSP prior to age 71, you can maintain those because all the RIF is really a continuation of your RSP, except that in the RSP was a PAM, in other words, a deposit account. Now the RIF is basically a deaccumulation. So the RSP was an accumulation account. Now the RIF is a deaccumulation account. In other words, money starts coming up. But in terms of your options, in terms of where you can invest your money, the kind of risk that you can take, that really will be very much up to you. So it is very much of a managed type product where you really have to manage your affairs as well. So as I indicated to you, the RIF must start. You must start the RIF, annuitize it, the year you turn age 71. Okay, so you have to do it by the end of the year you turn age 71. So if your birthday is in September, for example, you've got to December 31st of 2017, let's say, to RIF your money. You cannot go beyond beyond that. The income could start a year later. What I'm saying is it has to be converted into some kind of an annuity by the year end that you turn age 71. Okay. All RIFs have what's called a minimum withdrawal. Okay, so there is a table under the Income Tax Act. There is an actual table that Ottawa provides for all providers of RIFs, all organizations financial institutions that sell RIFs. There is a table that says the minimum you must take out every single year is this money. So what happens basically at the beginning of the year in January, we say, okay, what's the pool? How much money is in this RIF? And then they say, what age are you? And there's an actual percentage. And so you take that percentage, multiply it out, and then divide it by 12, and that'll be your income. So for example, at age 71, if my memory serves correct, I think it's something like 5.86%, okay? So you've got $100,000, say, sitting in your RIF, 5.86% of 100,000, it's $5,860. Divide that by 12, and whatever that number happens to be, $500, 500 and change every single month. That is your minimum. So that minimum changes every single year. Okay, it actually goes up every single year. So by the time you actually get to age 94, for example, you must take out 20% of the pool, basically, again divided by 12. So that number changes year by year. So if you look at the financial papers, you'll see those tables, and those are consistent. It doesn't matter which institution is managing your money. So it's not a question of that one company has a different table than the other. They all have exact same table. So the minimum is a must, and on that minimum, there will be no withholding tax at all. They'll all be taxed, but you're not going to get taxed up front. You just simply basically report all that as taxable income at the end of the year, that kind of stuff, okay? Anything above the minimum, in other words, anything in excess of the minimum, there is a withdrawal, okay? In other words, excess withdrawal over and above the minimum, that will be subject to withholding tax, okay? And that will be subject to the same withholding tax that you're familiar with before it's 10%, 20%, 30%, depending on how much you're actually taking out that particular year. So once again, if you take out an extra $5,000, let's say, that'll be 10% of $5,000. If you take an extra $15,000, it'll be 20%, and so on and so forth. Okay. So basically, what we're saying is that the minimum amount, that whatever that table shows up, not a problem. There's no withholding tax on that. You simply pay your tax on it at the end of the year. But if through the year you decide I really could use an extra $10,000, let's say, because I want to take a holiday or something, you're certainly welcome to do that. Just be aware that that extra $10,000, you will be subject to a withholding tax on that $10,000, which then will be credited to you for the end of the year. So you're not being double taxed. All you're saying is paying out the tax, paying your taxes up front rather than deferring the tax. Okay? While there is a minimum in a RIF, there is no maximum withdrawal. So basically, if you decided you want to cash in the whole thing, that's certainly your privilege, okay? This money is not locked in, okay? So it's very important to remember that RSP money and RIF money is not locked in money. So if you decide you're 75, you're 80, whatever it is, and you said, let's say I've had enough, I'm going to pack it in, just cash the whole thing in, you're certainly welcome to do that. So there's no limitation as that is concerned. However, just be aware that, again, it's all going to be taxed. So it may not be worth your while to sort of basically collapse the whole thing and pay your taxes. But that's something that you and your advisor will have to decide in terms of which is your best way of doing it. Now, I indicated to you that there is a minimum withdrawal that you must do. And so one of the questions always that shows up on any exam is how can we make sure, or how can we minimize the possibility that we may end up actually running out of money? Remember that in a life annuity, which again you could buy a registered life annuity, okay, that gives you an income for the rest of your life. So therefore, that income will never stop. It continues on forever and a day. With the RIF, if you've been aggressively taking out more money than you should, for example, you might find yourself in a situation where suddenly you're 80 years old and you're basically down to almost nothing, whatever it is. Okay, so there's always a fear on a RIF because there's no limitations here, based on what you can withdraw, that you could run out of money. So one of the questions on the exam is how can the client minimize the possibility that they will run out of money? Well, one of the most cleverest way of doing it is instead of using your own age as the starting point, you can use your younger spouse as a starting point. In other words, there would be a lower minimum. So if, for example, at age 71, the minimum I must take out is 5.86%. But at age 65, let's say that my spouse is 65, it's only 4%. I can use her age instead of my age. So the starting point now is at 65 and it's at 4% instead of 5.86. So because I'm not taking out as much money, I'm only taking 4% out instead of 5.86. That means that theoretically, if I do this right, the money should last for a longer period of time. So three things that you could do to make sure that you don't run out of money. Again, these are not guaranteed, okay, but could be. One of them is use the younger spouse as your for your younger age for your minimum withdrawal. Another one, of course, is basically only take out the minimum. Don't take out excess amount of money or limit the amount you can take out excess. So don't use it as a piggy bank, so to speak. And anytime you need money, just go in and take it out. Because remember, there's going to be limitations to all this. And the third one, of course, is what we call asset allocation, which basically means manage your money properly. You make sure that you're not taking too much risk, because as you get older, risk taking becomes very, 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 very expensive because you don't have the time to recover from a loss. So three things that you can do to minimize the possibility of running out of money is use your younger spouse as for the minimum withdrawal. Okay, minimize the amount of excess withdrawals, so don't take out too much money over and above the minimum, and of course asset allocation. In other words, manage your money properly so that we make sure that the money will last for a longer period of time. And that should be it for now, and we'll see you next time.